Good evening. Sorry, not the evening. Just good afternoon, everyone. I hope you're all good and healthy.
Hello, Professor.
Hi, Professor.
Today I'm just thinking whether to just go over the solution or not, or just provide you, and I'll just proceed with my lecturing. I think I'll start my lecturing, and if there will be time, I will go with the solution. If not, I will upload it on the Moodle, and you can check it, the solution from there. The solution from the activity, the sample of the exam 1 question. Okay. Okay. Today we're gonna start a new chapter, which is cost of capital. So far, we have been discussing about the investment criteria we were using to estimate the feasibility of certain projects, whether the certain project should be accepted or rejected. And we were using the cost of capital, or we call it a discount rate or required rate of return, or how it's called, like average cost of capital, marginal cost of capital. So all the names are used interchangeably. They all mean the same thing. The cost of using the funds that comes from the creditors and the owners. We know that the money comes either from the creditor or from the owner of the company or the project. From two sources. There is no other sources. Creating the value requires the investing in capital projects. So that provides a return and which is greater than the project cost of capital. So when we view the firms as a whole and the firm creates the value when it provides the return, that will be the greater than the cost of capital, then certain project will be accepted. So estimation of the cost of capital is a bit challenging issue. So first of all, we must estimate it because it cannot be observed easily. We must make a number of assumptions when we do the estimation of the cost of capital. And for a given project, the firm's financial manager must estimate its own cost of capital, because cost of capital will change from project to project, from industry to industry. Why, you will understand later. You will see the components, you will see the ingredients of the cost of capital formula, how it's estimated. So before it was given already calculated, but this time we will learn how to calculate the cost of capital. Cost of capital basically is the rate of return that the suppliers of the capital or bondholders and the owners, they require as compensation for their contribution of the capital to finance a certain project. The cost basically reflects the opportunity cost of the suppliers of the capital. And we know what is the opportunity cost like. It is the cost that is incurred that you could have earned it somewhere else, but it's a potential loss. Your opportunity cost of coming here is maybe you could have gone for sleeping, or you could watch movie or something else, but you came to the class and now you're listening to me. And cost of capital basically is marginal cost, or the cost of raising some additional funds. So in other words, it is called as weighted average cost of capital. It is the cost of raising additional capital with a weight representing for the proportion of each source of financing which is needed. And also it is called as a marginal cost of capital. So these words will be used interchangeably in the whole industry, not only limited to this course, but in all finance industry. So like whenever you go and whenever you work in any place, you will see like weighted average cost of capital, marginal cost of capital, discount rate, required rate of return, and so on. So these all words, the phrases, they mean the same thing, like the cost of using the funds that comes from the creditors and the owners. The formulation is given here, as you can see here, the WACC, which is abbreviated as weighted average cost of capital, VD times RD times 1 minus T VP times RP, and VE is RE. So we, or we can say W, represents the proportion of the equity or proportion of the debt, proportion of preferred equity is used. Like how much of the money is used to of debt is used to finance the certain project. How much of the preferred equity money was used to, if this is, let's say, 70% and this is 20%, then the last one should be 10%. The summation of all the proportions should come up with 100%, okay? So it shows you how much of the money of certain debt is used to finance asset or project, how much of the preferred equity used to finance asset or equity itself, the common equity. So there are three main components that should not be ignored, okay? But in most frequent time, the preferred equity is not considered because not all the companies which are publicly traded, they do have this proportion of equity. If they don't have any preferred stock or preferred equity, then there is no need to calculate. There is no, just make it zero. So you have like two components. But if the preferred stock and preferred equity is used in certain publicly traded company, then for sure you're gonna use this thing. So WD represents the proportion of debt that the company uses when it raises new funds. RD represents the before tax marginal cost of debt, and it is subject to the tax. So T is the company's marginal tax rate. WP represents the proportion of the preferred stock company uses when it raises the new funds. R and P is the marginal cost of the preferred stock. Proportion WE as it goes in the following way, like WE and RE, the proportion of equity and marginal cost of equity respectively. So basically, we will be using this formula to calculate the WACC. So in this chapter, you will be responsible to estimate or to compute the weighted average cost of capital, which will help you to estimate the feasibility of the certain project when you use NPV, IRR, or MIRR, or any other investment criteria when you need to use this discount rate. Example of WACC, okay, is given below in the next slide. Suppose the widget company has got the capital structure composed of the following in billions. So what is the capital structure? Capital structure shows you how much of the debt and equity are used to finance the assets. We know the assets are equal to debt plus equity. So how much of both are used to finance the asset? Okay. So this is how it shows. This is the equation that comes from the accounting. And there is a cost of debt before the tax is given as a 9%. There's a required rate of return of 15% is given, and tax rate is 30%. So what is the weighted average cost of capital? So what are you doing here? Basically, everything is given. You need to just substitute into the formula where you will estimate the WACC or marginal cost of capital or discount rate. So everything is simple. Everything is provided. You need to just put it an estimate, except the proportion. Okay, as you know, the proportion is like in here. We are not given any preferred equity or preferred stock. So that means, let me go back to this formula. So in here, as you see the formula, proportion of debt and proportion of equity, but we don't have any preferred stock and preferred equity, so it's not existing. I'm just canceling out. So we are left with the two components of the WACC. So we need to find the proportion of debt. What is the proportion of debt? Like how much of the debt is used to finance the assets? So it's just simple proportion of debt. Who can help me? Please go ahead. Anyone who can help me?
40 plus 10. 10 over 40 plus 10.
10 over the summation of these two. Very good. And what will be the proportion of equity then? If this is like 20%, like 0.20, 1 over 5. And what will be the proportion of equity? It's basically 1 minus proportion of debt. So whatever is left, 1 is the 100%. So that means like 0.80 and 0.20. 0.9 is the cost of debt, cost of equity, and cost of debt is subject to the tax. And we just multiply and we end up with 13.25% as weighted average cost of capital. But the things are not easy as it can be seen in here. It can be seen like it's a piece of cake to calculate, but when it comes to the reality, it doesn't end just here. First of all, once you know what is the proportion and capital structure, how it's given, but the idea is that you need to calculate the cost of debt. You need to estimate cost of equity. Okay, beside the estimation of the proportion. Okay, beside putting into the calculation the proportion, like we need to estimate the cost of equity and the cost of debt. The cost of debt is much easier to calculate and estimate because it's already available. But when it comes to the cost of equity, the challenging part starts actually from here when we come to the estimation of the equity part. And because there are many ways to use, there are many ways can be used to estimate the return on equity, but issue is related to whether the company is publicly traded or is not traded. When it's a private company, the information about the private company is not available. It's not that much as could be available in publicly traded companies. So to sum it up, everything can be estimated easily, and there are some formulas we will be using it to estimate, but the cost of equity will consume the timing of calculating return on equity. So it doesn't go that much easy as it could be. But still, you can do it, but there are many ways to go with it. So there's another example, when the widget company raises like €1 more of the capital, it will raise this capital in the proportion of 20% of debt and 8% of equity. Its cost will be at least 13.25%. Okay, the taxes and the cost of capital. Interest debt is tax deductible, and therefore the cost of debt must be adjusted to reflect this deductibility. So we multiply before the tax cost of debt by the factor of the tax, and the T represents the marginal tax rate. And this is how it works actually. So the weight should reflect how the company will raise additional capital. Okay, the proportion, what it tells you. Ideally, we would like to know the target capital structure, which is the structure that is the company's goal, and we cannot observe this goal. Alternatives: access the market value of the company's capital structure components. And second, you should evaluate the trends in the company's capital structure and use some capital structure comparable companies in order to follow up if nothing is given. We are using the comparable in case if the company is privately owned and the financial information about this company will not be necessarily available if it's privately owned company. And when it says the target capital structure, actually in most of the post-Soviet Union countries like Russia, Kazakhstan, Kyrgyzstan, Azerbaijan, this cannot be applied, target capital structure. So first, what is the target capital structure? Target capital structure, when the company decides my target capital structure will be 30 to 70 for the coming 3 years, let's say, or for 5 years, whatever the case. Okay, they put the target and they will just keep it. So this is debt and this is equity. So they will fix it like this and they will keep it, because in this case they will kind of maximize their profitability, putting the target capital structure. However, this is not applicable in the before mentioned countries like post-Soviet Union countries. And why it is not applicable? Is there any idea who can just share their opinions? why it cannot be applicable like in Europe, like in Western countries, like US, Australia, Canada, but it is not applicable in Kazakhstan, in Russia.
Maybe
What do you
because
think?
these are developing countries and you cannot put a target capital structure.
Kind of, but it's very, very far away, indirectly related to what you have said, but there's some very specific things related to basically to debt. The debt actually keeps this target capital structure, or it doesn't keep it, it changes. There's something called like related to this and this. That's why it's not applicable in the before mentioned countries. So what could be the reason for that? Okay, let me ask you this question. Have you ever got the loan, or have you ever taken any loan from the bank or your parents? I'm not asking the amount, just say yes or no.
Yes.
Okay, how it works, help me. For example, I go to the bank. Okay, I'm going to the bank. Let me open the Excel.
Yes, and
Just a second, I'll open the Excel. So I go to the bank. I take, let's say, 500,000 tenge from the bank. Okay. The interest rate is 20%. Does anyone knows how it works?
I mean, like the repayment schedule, how we pay the interest first and then the principal amount?
Yes, very good. Very good. So when we pay the debts, let's say for monthly basis, okay, I'm gonna pay it in 2 years. How many months I'm gonna pay every month? If I'm gonna pay every month?
24.
24 months, okay?
Wow.
24 months. Like I'm gonna pay in an equal payment, like I have to calculate the total payment or equal annuity payment. I will calculate it, okay? And if this is the case, let me put it like this. Just want to illustrate to you something. 24 months, I took 50,000. My equal amount, if I'm not mistaken,
is it 20% for each year?
yeah, the 20% is for each year. Rate should be divided by 12, yes?
Yes.
Number of periods, 24. Present value, this,
Minus 500. So
and future value, we don't know.
Yeah, we just conclude now.
Okay, this is my,
Payment every month.
oh, sorry, I should fix it. Otherwise, it's going to destroy everything. So this is gonna be my total payment, yes? I'm just trying to create a table which is called, who knows the name of the table?
Repayment.
Amortization table.
Amortization.
So then I pay the interest. I mean, this amount includes what?
Principal and interest.
Debt and
Interest
interest.
and
Debt.
principal amount, the original value of the debt. You're right. And we have ending balance. Okay. So how can I find my interest in this year, in this month? How much I paid interest?
500,000 divided by 24.
multiplied by 100.
So this just basically multiplied by 20% divided by 12. Yes?
Yep.
Correct?
Monthly interest payment.
Or we can make it like this, monthly interest rate. And just multiply with this rate. Okay. This is monthly rate. And this is yearly rate. Now, what is my principal paid? How can I find my principal paid?
25 minus 8.
Yes, very good. So this minus this. And my ending balance will be this minus the principal amount. Okay. And of course, my beginning balance of the second year is the ending balance of the first year. I basically just make it like this. Oops. And of course, I should have fixed it. I should have fixed it. Okay.
No, that the G5 should be not absolute.
Okay. Now, at the end of the day, my ending balance will be equal to 0. This is how it works. Yes, this is, we know the general. If you go to any bank, okay, you borrow this amount and you pay this in total every month, and your interest will be this much, principal this much. But if you go to, what do you call it, as a company, it doesn't matter if you go as a corporate, if you go as a, yeah, like individual or company, the payment will be the same. The structure of the payment is going to be same, like interest plus principal.
Mhm.
So we are paying all the same. So do you think that for the companies, it's going to be very easy to keep stable their target capital structure when the debt is changing every month or every year? Okay.
No.
But if you go, let's say, for these Western countries, okay, especially the principal amount, the West countries, US, America, US, Canada, Australia, Europe, they keep fixed the principal. The company pays only the interest every period, like yearly or quarterly or semi-annually. But at the end of the maturity, they pay the whole amount of the debt. I mean, the whole principal. That's why it is easy for them to keep stable the capital structure. Does it make sense to you now?
Yep. But why don't we do it?
Because you have already, somebody already mentioned in the class, like there's a difference between the countries, developing and developed countries. So the banking system, the financial system is not much developed as in those countries.
Okay.
If you, for example, I have my friend, he's a contractor. He has a construction company. He builds flats in Germany. Okay. Imagine you got kind of mortgage from the bank in here. But if you don't pay, let's say for 1 year, what happens to you? Your flat is under the collateral and it's a mortgage-based flat. So what happens to your flat? Talk from the perspective of the borrower, like what happens if you don't pay, what happens to the borrower? How the banks will, what act in this case?
The bank takes away the apartment and sells it off.
Yeah, generally, basically how it works in developing countries. But if you go to the developed countries, like European countries, the example that I gave you, Germany, it is the real case. Like we were discussing, like maybe 1 hour, 2 hours about the system, how it works. And he explained that there are many customers who could not pay their loans, but the bank did not take away the flats. The bank finds another institution to refinance that debt instead of just taking away the flat and reselling it. Can you imagine? For example, first, if you borrow the flat, so if you borrow the money to buy the flat and you didn't pay for 3 months, okay, you didn't pay for 3 months. Basically, the bank is eligible to charge some penalties for you, except like apart from the paying the interest plus penalties. But the bank does not do it. The bank gives you kind of not a warning, how he said, notification. Okay, he gives you notification that you have missed 3 payments. Please be punctual and paid on time. But something went wrong with your business. You go to the bank and ask them to help. They find a solution to you. Maybe they refinance it. They find another bank to refinance it, or they make a kind of freezing. They kind of freezing the payments for you for some period before you get well. And that losses that the bank incurs will be compensated by the government. This is how it works, basically. So there is no that much pressure. But before the global financial crisis, of course, there was cases like the people, they lost their house, but after that, the legislation was reviewed again, and they just reconsidered everything, and they just come up with a certain legislation that the banks, they don't have a right, and they give many privileges for the borrowers. Like in Turkey, for example, my brother is living there, and he's saying that if you sell the flat, sorry, as a construction company, and the borrower or customer is not paying for a couple months, you don't have a right to put out from the flat the customer itself. Like there is no certain regulation that the police can come and make you out from the flat. So there are many things that, like, the financial institution is much flexible and developed in those countries, and we hope that our financial institution will reach to that point. Definitely, they're gonna reach for that, but it needs a time for it. It needs a time for it. Okay. So that's why, ideally, all the companies, they prefer to have some target capital structure, but it doesn't work all the time in some countries. And why it doesn't work, you know already. So the WACC is the marginal cost for additional funds, and therefore it's additional investment. In capital budgeting, we use WACC, like adjusted for project specific risk, to calculate the NPV using the company's overall WACC in evaluation of the capital project. Assume that the project has very similar risk to the average project of the company. The formula of WACC consists of proportion multiplied by return on debt or return on equity. And how to calculate that cost of debt or cost of equity or cost of preferred equity is just lined up in here, as you can see here. Like there are two methodologies of estimation the cost of debt, like using the YTM approach or using the debt rating approach. When it comes to the cost of preferred equity, you can use it two approaches. It's return on preferred stock and variation because of callability and so on. But this is not that much popular because not all of the companies are using the preferred equity or preferred stocks, but so that it's not that much frequently used as this two, like cost of equity and cost of debt. As I said in the beginning, that the challenging part starts from the estimation of the cost of common equity. Cost of common equity can be estimated through the three different methodologies, like which are here, as you can see, like CAPM model, capital asset pricing model, DDM model or dividend discount model, and bond yield plus risk premium model. This is the most easiest part. So DDM, CAPM. So among these three, the complicated way of estimating cost of common equity is CAPM. So we'll spend more time on the CAPM. So you can estimate easily cost of debt using one of this approach. Proportion can be estimated using the approaches given, like mentioned above. And when it comes to the cost of common equity, you can use one of the three approaches. If it comes to the CAPM, then we're going to spend a bit time on that. Cost of debt: if company has publicly traded long-term investment grade debt, cost of debt is determined using the YTM. If the company has outstanding debt and it doesn't trade regularly, cost of debt estimated using the average yield of similarly rated debt, like it's called comparable method. If rating doesn't exist and the company's debt and estimate a synthetic rating and refer to number 2. Alternatively, use risk-free rate plus some default spread approach. And company has speculative grade debt. Cost of debt is calculated using the capital asset pricing model, but the most popular one, first and second one. YTM approach, consider the company has got 100 million of the debt outstanding and that has got the coupon rate of 5%, 10 years to maturity, and it is quoted at 0.98. So what is the tax? What is the after-tax cost of debt? Marginal tax rate is 40%. So assume the semi-annual interest rate. So in this case, we're estimating for the rate. Okay, it's a bond valuation. In the bond valuation, everything is given. The bond value is quoted at 0.98, which means that the price of the bond is 98 and the face value of the bond is 100, where the coupon rate is 5%. Now we can estimate what we call it as YTM itself using the Excel spreadsheet, or you can use the financial calculator, one of this. So it's up to you. So as you can see here, the cost YTM is equal to 3.156, and the cost of the debt is equal to this, like it's before, okay? And after, if you want to, sorry, I'm very sorry, it's already like computed using the tax rate, it's like 40%. So before the cost of debt is like 5%, and after the tax payment, the cost of debt is equal to 3.15. So the cost of debt is here. And there's alternative way is used like debt rating approach, like consider that the company has non-traded 100 million of debt outstanding and has debt rating of AA, and the yield on this AA debt is currently 6.2%. And what is the after tax cost of debt if the marginal tax rate is 40%? Then we estimate for rate for the similar bonds or for the similar debt, and as you can see, the cost of debt is equal to 3.72% after the payment of the tax. So the two ways can be considered. So definitely we're going to solve some examples and you will understand better how it has been done. But in reality, there are much more ways of estimating cost of debt and cost of equity. There are many things that can be considered actually. Synthetic rating approach. It's an alternative way is to play a role of rating agency. They assign a rating to a firm based upon its financial ratios, like rating is called synthetic rating. That makes this assessment. We begin with the rated firm and we are examining the financial futures or shared by this firm within each rating class. So once synthetic rate is estimated, it can be used to evaluate the default spread, which when added to risk-free rate yields, at the end you come up with the cost of debt, like some financial ratios given, like EBITDA over average asset, operating margin, EBIT margin, coverage ratios, and so on. You make some estimation here. Then you, if coverage ratio, you put some for smaller and riskier firms, like make categorization by rating system, like using the spread, so on. So you're not actually based on, if you put everything into simple words, it just gives you the information of calculation. If you wanted to go more deeply to see how they do it, you can do it in the book. But from my side, I will not ask from you to do it. So, but you will be responsible for these two ways, okay, of estimating the cost of debt, YTM and the debt rating approach. The third and the fourth way, you can learn it, but still, I will not ask it. And this is how the cost of debt estimated. Cost of preferred stock is basically, it's a perpetuity. The dividends are paid forever, as you can see here. The cost of preferred stock is non-callable and non-convertible. It's based on the perpetuity formula. It's basically dividend paid, like of preferred stock, over required rate of return on the preferred equity equal to the price. And we are given price and we are given a dividend payment that will help us to find the cost of preferred equity. Like the example given below, like suppose the company has preferred stock outstanding that has got the dividend of 1.25 per share, and the price of that stock is $20 per share. And what is the company's cost of preferred equity? Is just putting everything into the formula. You just estimate, and you're coming up with 6.25%. And it's not subject to the tax. Only the cost of debt is subject to the tax. Okay. And the interesting part and the main part of this chapter, how to estimate the cost of equity using the three models. The three methods. One is the CAPM, the other one DDM, and the third is bond yield plus risk premium. Starting with the CAPM, okay? Capital asset pricing model states that the expected return on equity is the sum of the risk-free rates of the interest plus premium, the bearing the market risk, and risk premium from the market risk is expected return on the market, RM minus risk-free rate. So when expected return on market minus risk-free rate is all about the equity risk premium. So this is the CAPM model. We're going to use it to estimate. So the challenging part in this model, like risk-free rate is always given by the government, okay? Market risk, you can find it. Risk-free is given. Challenging part is to measure the beta. Is the sensitivity of the stock to changes in the market return. There are ways to calculate. We're going to see it, okay, a bit later. We'll see how it's being estimated. Okay, do you have any questions up to this moment? Anything you want to ask?
I think so.
No. So cost of equity using the CAPM model, the example is given, like if everything is available, okay, you don't have to estimate the beta, like everything is on the internet. Actually, the problem is when the company is not publicly available, then it is very difficult for you to estimate the beta. Okay, for the available companies, okay, let me go for Yahoo Finance just to illustrate the example to you. Let's say I want to go for Coca-Cola, okay, company. Here, the beta is here for Coca-Cola company for 5 years, okay? You can see it. So that means you don't have to kill yourself and just put everything into this formula and estimate your cost of equity easily. There is a risk-free rate. There is a market rate. That's it. You can easily estimate. However, and you put your substitute and everything. So risk-free rate is 3%, expected market risk premium is 5%, and company stock beta is 1.2. So what is the company's cost of equity? You just substitute and put it into the CAPM model. And as you can see, it's a 9%. There's nothing. It's just piece of cake to calculate when everything is given to you. And everything will be given to you in case to use what you call it for publicly available, because they are more transparent than privately owned company. Alternative models may be used to capture the expected return to risk factors, not incorporated in the CAPM. For example, we can use factor model, like factorizing, they call it, estimation the cost of equity using different statistical model, statistical softwares to use this. So basically, we will apply the regression analysis, but you're not responsible for that. It's just showing you that there is alternative way to do it. But as a popularity, it's not that much popular in terms of use. The second model, I will come back to the CAPM model again, but briefly I just showed you how the CAPM is estimated, but I will come to talk more specifically about the beta point. But let's move to the second model, second method of estimating the cost of equity. It is dividend discount model. Assume that the value of the stock today is the present value of the all future dividends that it will be received and discounted at the required rate of return. Assuming the constant growth in the dividend is 0, so which can be rearranged to resolve the required rate of return. Okay, so P0 is equal to D1R minus G. Okay, this is how we do it. Okay, return on equity. Okay, required rate return on equity minus G. G is the growth. Okay, which can rearrange to solve the required rate of return. So we can estimate the growth rate G by using the third-party estimates company's dividend growth. Okay, and some estimation of the company's sustainable growth. So sustainable growth is the product of the return on equity, and retention rates, it's 1 minus payout ratio. 1 minus payout ratio. So growth is equal to retention ratio. I mean payout. This is like 1 minus payout ratio, like retention ratio multiplied ROE. So basically, is this? Let me just type it. It's, I don't know what happened. So G equal to retention ratio multiplied by ROE. Retention ratio is how much money will be kept in the company. Like there is a net income, and net income is retention ratio plus payout ratio. So in total, how much money you pay as a dividend and how much money will be kept in the company. So retention ratio is this, 1 minus payout ratio. This is where you find the G, and you just substitute. D1 is given, P0 is given, and you put it everything here. But sometimes D1 will not be given, but D5 will be given. You have to convert back to the D1 using the required rate of return on equity. It's kind of refer to the financial management courses, for financial management course of principal finance that you have taken previously. If you forgot, I'm going to review it again, okay, later for you, so that you can have an idea about it. Suppose the gadget company has current dividend of $2 per share. Current price of company is $40 per share, and gadget company has dividend payout is 20%. The expected return on equity is 12%. So what is the cost of gadget company? First of all, they found the G, like retention ratio or 1 minus payout ratio, which is 80%, multiplied by ROE. Then they estimate, they just plug all the estimated numbers and all the given numbers into the formula, which is here, into this formula. Sorry, here, D1, P0, and G. But in here, 2 is not the D1. 2 is D0. How? So $2 is to D0 here. How can they find D1? Is D0, who can help me? Multiplied 1 plus G, the growth of the dividend, okay? The growth of the dividend. This 9.6%, the dividend grows annually by this rate to the power of 1, okay? How can you find D2 using the D0? D1, so D0, multiply 1 plus G to the power
2.
2. How can you find the D5? D0, 1 plus G to the power 5.
5.
What if you are given D3 and you need to find D1? Because according to the formula, you have to find D1.
Inverse it.
Just reverse it. Like we know that D3 is what? D1, 1 plus G, yes, to the power of?
To the power of 2.
To the power of 2. And we can find in this case we just replace it like D3 is given in order to find the D1 is basically D3 over like 1 plus G to the power 2. In this way, you can find the D1. So you have to play, you have to manipulate with the numbers, with the formulas in order to find. So this is kind of a hint for you. I might ask in this way, like giving you D3, like dividend in year 3 per share, and other information is given. So you need to find, first of all, D1. You need to convert the D3 into a D1 because you know what is the growth of the dividend. Okay, we'll continue. And using the bond yield plus risk premium approach to estimate the cost of equity. Bond yield plus risk premium approach, it requires adding the premium to the company's yield on its debt. Like cost of equity is equal to cost of debt plus risk premium. This approach is based on the idea that equity of the company is riskier than its debt, but the cost of these sources move in the same direction. Okay. Topics in the cost of capital estimation. First, you estimate the projects better, then estimating country risk premium, and using the upward slope marginal cost of capital schedule, and then you're dealing with the sum flotation cost. Okay, issues in estimation better, like challenging part. You remember, as I told you, we're gonna come back to the better estimation, to the capital model. Now we are back. So judgment is applied in estimating the companies better regarding the estimation period, the periodicity of the return interval, the appropriate market index, and adjustment for small company stock. So if company is not publicly traded and we are estimating the projects better, then we need to look to the risk of the company and the project. And we will use definitely some comparables, which means that we're going to select some companies from the same industry, but they are publicly traded companies. So when we'll select this comparable to estimate the project better, we ideally would like to find a company with a single line of the business. This is very important. It should be from the same industry. You cannot calculate for a company that produces, let's say, some drinks and use as a comparable some IT technology company like Apple, because Apple is available, so I will use the better for Apple. Do you think that it is logical to use the risk? Do you think that the risk of the Apple is the same with the risk of manufacturing company? No, definitely no. So we should use the comparable company from the same industry. The idea of this to select the comparable companies, when you do this selection and when you estimate, this model is called a pure play model or pure play method. So we use the beta of the comparable company to estimate the asset beta and then use it for the project company, then for the project beta. First, we estimate the asset beta, and this asset beta will be used to estimate project beta. Okay. So select the comparable, estimate the beta for comparable, then unlever the comparables beta to estimate the asset beta, and then lever it back to estimate the project's financial beta. Here, first, we estimate the beta asset. Second, when we found it, the beta asset can be estimated. This is beta equity for comparable companies. Okay, it's given, as I showed you in Yahoo Finance, like for Coke, it's 0.69 for 5 years. So we use that one in here to find the beta asset. Then once we have estimated the beta asset for the comparable companies, we're gonna put it in order to estimate the beta equity for the project or for a specific company which is not publicly available. Is this linkage or this relationship is clear to you? First, we estimate the better asset. Then we estimate the better equity project. Do you want me to repeat this again? This relation?
Could you please do it once more?
Okay, we have comparable companies, A, B, C. There are 3 comparable companies. Our project is H, okay, or company H, which is not publicly available, which means that all the information are private. We don't know anything. But industry, they're both are manufacturing, like comparable companies, and this company, they are all in manufacturing industry. They produce same product from the same line business. But for comparable companies, because they are publicly traded, all the information are available, like betas and everything, like better equity for these companies are available, okay? So we just use this better equity of this company in here to estimate the better asset. Why we are estimating the better asset? In order to estimate the better equity for the project H or for the company H, because H is privately owned and information is not available. So we're gonna use it here.
Okay. Thank you.
You're welcome. Example given here, okay? Consider the following information for the A project and it's comparable. B company. B is the comparable, all the information available. It's publicly traded. Project A or company A is not traded. So we are missing better here. So first of all, we need to estimate the better asset using the better equity company. So what we will do, we will use the information which is given here. Like 1, so better equity is this one. 1 over 1 plus 1 minus T. T is the tax, which is 40%. And D over E, debt equity ratio, like debt over equity, 1 over 2. So basically 1 over 1.4, we just plug all the numbers of the comparable companies into this formula. We plug it 1 over 2, and then we get beta asset is equal to this. So we found the beta asset that we looked for, okay? Why we looked for? Because we would like to estimate the beta equity for project which is not publicly traded, for the company which is not publicly traded, beta equity. So beta asset is substituted here, like 1.07. Then we put all the numbers same, like debt is given, equity is given, like 10 over 4. Tax rate is the same. And as you can see, the better equity for that project is equal to 1.23. This is how it is being estimated. Now the better equity is estimated, risk-free rate is given, equity risk premium is given. You just plug it into the CAPM formula, estimate your cost of equity. So there is in the book question, very good question that I will use it definitely to share with you to show very big comprehensive question, which we will solve it together to understand better how these all things are combined and used together. Country risk premium is an additional risk premium associated with the doing business in a certain country. So additional premium added to the equity risk premium, like here. It's a kind of expanded formula, okay? So if you're doing a certain country that has some country risk premium, you have to add it here, okay? So it's country spread. So the country equity premium. So this will be the country equity premium, like subtracting the risk-free from the equity return on the market and plus country risk premium. It's going to give you the country spread or equity country premium. So the only the difference in here is just you're adding this to here. So if in the question I give you the country risk premium, you have to use this formula instead the above which is given. And the rest is the same, like for calculating the betas. Marginal cost of capital schedule may be upward sloping and higher cost for raising more capital. And the point at which the cost of capital changes is the break point. And there may be many break points actually. So investment opportunity schedule is a representation of the return on investment. So investment opportunity schedule is downward sloping. The more company invests, the lower the additional opportunities will be available. So that is why the company will invest in the highest returning investment first, followed up by the lower and lower and lower. More capital will be available to invest in. Marginal cost of capital is the scheduled representation of the cost of raising additional funds. So we generally assume that the marginal cost of capital is upward sloping, and the more funds a company raises, the greater will be the cost actually. And basically, if you just put it all together, it comes as demand and supply. Flotation cost. Flotation cost is the investment banking fee associated with issuing the securities, okay? To treat the flotation cost accurately, adjust the NPV for the project for the monetary cost of flotation. So flotation costs occur immediately after when you issue the security, when you start your project, and it should be reflected, incorporated in the formula. So suppose the company has some project NPV of 100 million, and if the company issues 1 billion of the equity to finance that project, that flotation cost will be 1.2%. So the NPV after adjustment will be equal to 88 million. So flotation cost should not be ignored. Do not confuse with the sunk cost. Sunk cost is different. Flotation cost, it occurs when the company wants to finance their project through the issuing the securities, through the issuing the equity. So there is a cost, and it should be incorporated into the formula. It should be incorporated in the formula here. And summary. If you have any questions, please feel free to ask while I'm taking attendance. Adil? David? Alisa?
I'm here.
Aygerim? Aylana?
I'm here.
Abay?
I'm here.
Tamerlan? Tolebi? Okay, Aziza?
I'm here.
Adil? Maksat?
I'm here.
Aygul?
I'm here.
Dorijan?
I'm here.
Bella?
I'm here.
Fatima?
I'm here.
Alim? Saidat?
I'm here.
Okay, Abay?
I'm here.
Arnur? Okay, Dilara?
I'm here.
Fariza?
Here.
Nabi?
I'm here.
Okay.
Sorry, Professor, did you mark me?
David, yes, you're here. I saw you. You were trying to say something, but your voice didn't come. I put it yes.
Oh, okay.
Okay. For the midterm, the cost of capital is not going to be included, okay? For the midterm. It's just only lecture 1. Just be aware of it, okay? It's lecture 1. And let's come to the solution part. Let's come to the solution part. Here. Where's the question? Here's the question, okay? First of all, it is the replacement project. It is the replacement project. First of all. When it comes to replacement, there is incremental value you need to estimate, like incremental operating cost and depreciation. And the depreciation will be estimated as follows. So what happens here, as the question suggests, the Dutch group of company, one of the largest property developing companies in Cyprus with more than 30% experience in construction real estate. The Dutch group of companies wants to run with the replacement project. Here's the information about the project. So the cost of equipment is 400,000. It requires shipment and installation 10,000. So new equipment replace the old equipment with additional investment of 20,000 net working capital required. Okay. The tax rate will be 33%. The required rate of return will be 15%. And the project life is 6 years, but the fixed capital has 3-year class life, simplified straight line depreciation. So current operational expense is 640 per year, and new operational expenses 400,000 per year. Operational expenses 640, and the new one will be 400. So the book value of the old equipment is 0. There are no proceeds from the sale of an old equipment in year 0. So the sunk cost is 250. I hope you didn't use the sunk cost. You don't have to use it anywhere. The sunk cost is not included in the analysis. Shouldn't be included. Salvage value, value at the terminal year is 190. So basically, you need to estimate incremental value of the cost. The first thing that you should start working, like incremental, like 400 minus 640. What does it mean? It means that how much money you're saving from the buying new equipment and replacing with the old equipment. This much you're saving. The project is going to last for 6 years. Okay. It's going to last for 6 years. Okay. So you put for 6 years the cost saving. If you put it as a negative, there is no sale. Okay. We not consider any sale because sale is 0. Initial outlay is basically this summation of this amount, and depreciation is straight line to the 0. It's capital cost with installation, like 410 divided by 3, because it's gonna allow this equipment will be operated within 3 years, so depreciation should be estimated for 3 years. Okay, 1, 2, 3. You estimate for 3 years, and then EBIT, like cost minus this, you're gonna come up with this amount of the money, and because you're saving it, then tax is this much. You get operational cash after the tax, then depreciation is added back. And this is cash flow, you get it for each year except the last year. Okay, for the last year, the terminal value will be added. Terminal value will be added, like salvage value minus amount of the tax paid for the selling that for that, and plus net working capital.
Excuse
And
me, I have one question.
yes, please.
Why did you calculate initial outlay like that?
Like what?
Like you take the 430,000 as an initial outlay, am I right?
Yeah, very true.
So why did you calculate it like that? Because in your example, we did the same thing with initial outlay, and you used the different formula. And also, I found the formulas in your presentations.
Yes.
So I used the different formula, and I got 300,000 to 2,700. So
Let me go. Let me just explain.
I can show my screen if you want.
No, I want to just explain on the formulas to you.
Oh, okay.
I will ask you. I will ask you to share it later, but I want to show you on the formula because it's a replacement cost. Basically, here, initial outlay for replacement project, like fixed capital investment, net working capital, minus salvage value plus tax on the salvage value. Yes, this is how you use the formula. True?
Yes, yes, yes.
But we are not given any salvage value.
But we have salvage value at the terminal
For the
year
new
is
equipment, for old equipment, there is no salvage value.
the salvage value is given for the new equipment.
Yes, Here
Ah,
we go.
okay, okay. Oh,
Salvage
the same.
value terminal here is for the,
Mhm.
it
I
says the
saw
book
that.
value of all the
Mhm.
equipment is 0. There are no proceeds from the sale of the old equipment in year 0. Okay.
So this means that we don't have any salvage value for
All
all
the
equipment. This,
Yes.
yeah, okay. Mhm.
That's why it will be considered only this.
Okay, I understood. Thank you.
Okay, you're welcome. Then we proceed and we calculate the salvage value of the new equipment, estimation of the terminal value, and we estimate the NPV, IRR, payback, profitability index, and payback rule. And then we make some decision. So second question was asked to estimate economic income and economic return. They are totally different. This economic return, it's not the economic profit, okay? It's just percentage return. How much you return in terms of percentages. But it's not the economic profit. Do not confuse it. So we go with economic income, okay? We calculated everything. We put it down here, okay? These are the cash flows, okay? Before estimating the NPV. So beginning market value. So I'm estimating the economic income. If you go with the formulas of economic income, just want to share with you the again formula. So I do everything as in the previous. I just copy and paste it from the above calculation. Okay, I put it here. Cash flows. So I need this cash flows. So basically, what I used to do it, I needed this. So here I put it again. I just copy and paste it. So now there's a formula. I'll go to that just a second. Here, economic income. Cash flow that we estimated after tax minus economic depreciation. Economic depreciation is what? Is beginning market value minus ending market value. How do I estimate my beginning market value? It's just the NPV for all the cash flow. So without subtraction the cost. So I just take the present value of the all cash flows that I have. Okay. For this year, for year 1. And ending value, then I go for the second year. I estimate the present value of the cash flows, including with the second year, but the previous one, I'm not including it. Go for the third one, just present value of the cash flows remaining. And so for all years. Then ending market value in year 1, it is the beginning market value of year 2. Ending market value of year 2, it is the beginning market value of year 3, and so on. It continues like this. And in the last year, there's nothing. So basically, according to the formula, it's cash flow minus economic depreciation. Economic depreciation is what? Beginning minus ending. So beginning minus ending. Beginning minus ending. And my operation cash flow here. So basically this is going to be subtraction, and if you minus should give you the plus actually. So my economic income is here for all years. Or you can do it in a vice versa way, like cash flow plus ending market value minus beginning market value. Like same, like cash flow plus, sorry, open the bracket, ending minus beginning. Okay, same. So you use one of the formulas, it gives you the same results. I use this one, but you can use this one. It's going to give you the same exact results. Then economic income is just this should be divided by this. So this economic income, I get it, divided by the beginning value of the market. And economic return is equal to 15% for all year. Okay, I will put it into Moodle this. You can use it. You can have a look at it. Okay, I will put it on Moodle. If you have any questions, feel free to ask.
I have a quick question. Can you show the payback rule again? The number you got, the formula you used in there, 2.09. Minus C63. Okay, cash flow minus cash flow. Cash flow. Okay. Thanks.
Okay. So I will put this, sorry. I'll copy it. Save. Where was it? If you have any questions, feel free to ask, like while I'm putting it. Just feel free to ask. Corporate finance, and I'll say this example.
No questions so far.
Okay.
Thank you.
Sample exam. Call it. If you don't have any question, thank you so much. I will see you then on Monday.
Okay, thank you.
Thank you. Take care, guys.
Will you put this file to the Moodle?
Yes, this is what I'm doing now. I'll put it now immediately.
Thank you so much.
You're welcome. You're welcome. Take care.
Thanks,
I would-
bye.
Is it enough just to prepare from the presentations for the midterm?
I will strongly recommend you to go through the book as well. In the book, there are very good examples. Sometimes I will be in the mood to take directly those examples. Just pass through those examples as well.
So,
From the
how-
book itself.
а там же ответы есть, да? То есть, how can I be able
Everything, all the solutions are there. For each question that you have it, they have all the solutions.
Okay, thank you.
Я не
Goodbye.
говорю не только в конце книги, которые есть вопросы, а в самой книге, когда они объясняют тему.
Да, поняла. Chapter 1, да?
Да, не чаптер первый, лекция первая, а чаптер там второй идет.
Все. Ага. Спасибо.
До
Большое. До
свидания.
свидания.